Hey everybody. In this video, I'm going to talk about private mortgage insurance and when you have to pay that because you didn't put a down payment on your house. And I just want to kind of prove some mathematical information to you and just present it to you in a way that's easy to understand, but also explain it. So if you don't know what private mortgage insurance, this happens when you buy a home and you don't make a down payment that's at least 20%. So what this means is the mortgage company is going to charge you a monthly premium because you are a risk of making a defaulted payment or not making your payments. So they basically do that. So let me give you an example. Every one of us have a bank account and every one of us have money in that bank account, some less than others. But if a person walks up to you, let's say your best friend or even your parent comes up to you and says, "Hey, can I borrow $6,000 from you?" Usually that makes people pretty apprehensive where they're like, well, depending on how much money you have in your bank account, you might be like, that's a high risk or not for you. But all things aside, let's just pretend you had $1 million in your bank account. Okay. Not that that's very many people, but just in this scenario, let's just pretend if you had $1 million in the bank and someone comes up to you and says, "Hey, can I borrow $12,000 from you?" You can say, "Well, sure, I can lend you the money." But a part of you might be like, "Well, are you going to make your payments?" Because let's say you have knowledge that this person has a history of not making payments. Well, you're going to want to get your money back somehow. So you might ask this person for what's called collateral. So the down payment, in a sense, is collateral. If you don't make a down payment, that means you've basically put no collateral down in front of the mortgage company, and they have an interest to charge you private mortgage insurance for that reason. But basically saying, look, if you default on the payments, we keep that money. So that's what private mortgage insurance is. It's basically them charging you a monthly fee to mortgage your house because you put no money down. Now, again, keep in mind that if it's less than 20%, that's when the mortgage company has the right to do this. And I'm sure that they do it in all scenarios. I can't imagine they wouldn't. But it's worth mentioning that private mortgage insurance is charged to you on top of your mortgage payment, and it's dead money. So, in other words, it doesn't go towards the interest or the principal of your property. That private mortgage insurance is 100% paid to the mortgage company, and they keep every penny of it. So, it's not saved for you, it's not given back to you, it's 100% dead money. But one of the things that Fannie Mae, this website's really good at explaining it in a short and concise manner. And I really like how they kind of presented the information where they said, look, the most important thing to know about PMI is that it's not forever. Generally, PMI can be removed from your monthly payments in two ways. When you pay your loan balance down below 80% of the purchase price of your home, or once you have achieved 20% equity in your home. It's basically the exact same statement. So how long does it typically take a person to get to 20% equity if they made no down payment? Well, that's contingent on several factors. So typical mortgage will never reach a point where they're exactly 50% goes towards interest and principal. But in most cases, what they call the tipping point, where your payment goes towards principal, more towards principal than interest, usually occurs roughly halfway through a 30-year mortgage. Now, again, that's a very strong assumption. And it's based on what's called the amortization schedule. The amortization schedule is what's given to you when you buy your home. And that could be weighted, basically 90% of your loan is going towards interest and 10% of it goes towards principal. Where your payment, if you were making a 900, or let's say you're making $1,000 payment for your mortgage and that's your mortgage payment, well, 90% of that goes to interest, which is $900, and then 100 of it goes to principal. And as time goes, it very slowly starts to move more towards the principal side. So, in 10 years from now, you could be paying 60% interest and 40% principal. So again, it changes, and it's a schedule that they give you, and it's a very long legal pad document that includes all 30 years or 15 years broken out for you. So again, the assumption is after 15 years on a 30-year mortgage and after, maybe 7.5 on a 15-year loan. But again, it's got lots of factors involved with it. But to the point, I created this private mortgage insurance versus down payment estimator. And again, the whole point of this is to specifically talk about, hey, should I make a down payment mathematically? Does it make sense to do it? Let me just make a very, very strong statement to you. I'm not telling you you should follow my advice. I'm just pointing out the math to you and showing you what makes sense mathematically. you have to decide several things like, can you afford private mortgage insurance if you're not going to make a down payment? Because in some cases that can be, anywhere from $100 a month to several $1,000s a month just in private mortgage insurance. And you have to understand that, look, if you're buying a $500,000 house, that could be quite substantial. But this kind of helps break down the math for you in an easy, digestible way where you just have to enter in a couple of things. And more importantly, if you don't make a down payment, how much do you set to make an interest on that if you invest it? And again, you can do a safe route investment where you invest it in a CD, or you can put it in the market and chance making more or less. So I'm going to use my example. So let's say that I did not make a down payment on my home. Unfortunately, I made the mistake of putting a down payment on my house. I'm not going to really call it a mistake, but mathematically, when I look at the numbers, it makes me a little sick, but there's nothing I can do about it. The money's gone. I can't get it back. Let's just say that the price of the home is $244,000 and that's what I mortgaged with no down payment. Okay, let's say that I just paid the tax, the title, and all that other stuff that I had to pay for and the notary fee, but I'm just mortgaging this month. But on top of that, let's say what interest rate would you make if you invest your down payment in an interest-bearing account or stock market investment? And again, we are assuming interest is compounded monthly. So again, things are much different in the stock market, but if you put it in something like a CD, obviously that's going to be compounded monthly, but we're just making a large assumption that most of your interest is compounded monthly, so 12 times a year. Let's just say you set to make 3.5%. Now we're going to check these values here just to make sure they're not blank. And now it's asking how long will you be taking out a mortgage for? So I'm going to say 30 years. Once I do that, I'll click calculate. Now, the information that's presented to you down below is going to basically tell you what the annual cost would be for private mortgage insurance without a down payment based on whether you're a high risk or a low risk. And then, of course, it's going to break down the total annual interest you can earn at 3.5%. But then it gives the total cost after the tipping point. So remember, the tipping point is when you hit 20% equity in your home. And again, we're assuming halfway. So if it's a 30-year mortgage, 15. If it's a 15-year mortgage, we're assuming 7.5. Real simple. So let's break down the math here and kind of explain what we're looking at. So first and foremost, you might be asking, well, what's the difference between low PMI and high PMI? Well, basically, low PMI is saying you have a really good credit score, and if you don't make a down payment, that this mortgage company is going to charge you private mortgage insurance. And I'm not saying you're guaranteed to get this amount because this is just the range that they've provided online. But they'll say, look, you're a low risk because because your credit score is very high. So we don't think you're going to default on payments. So the risk of yours is much lower. So we're going to charge you a lower PMI cost because, again, that's the total cost of the home. So they take $244,000 and they multiply it times 0.5%, and then they divide it to figure out what that cost would be on an annual basis or a monthly basis if you need to break it down. Now, a high PMI on the other course, again, that means you're a high risk because you probably have a very low credit score. And again, a high credit score means that I make payments on time and I'm a very good credit risk because chances are I'm always going to make my payments on time. That's what a credit score basically says is, can you make payments on time and can you do things on time? Well, a high PMI score means that I'm a high risk. So that means I have a low credit score. Well, in this case, you can see the cost of these are much different. So let's just say that you have a high credit score. So you'll probably get a low PMI. Well, assuming it's at 0.5%, your annual cost in PMI insurance would be $1,220. So that's a little over $100 a month that you would pay on top of your mortgage payment and your escrow. So again, can you afford that on an annual basis? That's up to you to decide, but you also need to figure out the monthly to decide if that's what you want to do or not. Now, if you're a high risk, meaning that you have a very low credit score and you're buying a house and you're not making a down payment, well, basically you're seeing 2% as being what the norm is. And I'm not saying it'll always be that way, but that's what they've advertised online is a 2% annual cost on the cost of your home. So in other words, you're going to be sending them 48.80 in annual premiums for this private mortgage insurance. And if we do the math on that, that comes out to $400 a month on top of your mortgage payment and your escrow. So if you paid $1,000 towards principal and interest, and let's just say, $300 in escrow that goes towards your taxes and homeowners insurance, you would pay an additional $400 on top of that to go to private mortgage insurance. So you're looking at a $1,700 mortgage. That's quite a bit the last time I checked. But here's the thing. The other point is deciding, well, hey, how much money would I make if I did invest that 4880 in this case at 3.5% on an annual basis? Well, I would make and I would be set to make 22, almost 2250 in annual interest. So, in looking at this, I want to point something out to you. And again, this is not me trying to tell you what to do, but just giving you mathematical logic. So, there's always a point to say, well, look, if this is how much I'm earning and this is how much I'm actually having to pay. So, in other words, expenses. So, like my expenses are $1,200, but I'm making $2,200. You're still clearing over $1,000. So in most cases, you look at this and say, well, look, this is a good point for me to not make a down payment because I am I have a very good credit score. I have a low PMI cost. So it's worth it for me to not make a down payment. On the flip side, if I was paying $4,800 in annual costs towards my private mortgage insurance, this case, it would say, well, look, now I'm losing money. So it's probably in my best interest mathematically to make a down payment because clearly I can't make more in the market than if I were to pay private mortgage insurance. But again, you also have to look at the fact of can you afford that payment to begin with? Now that's the annual cost. But now let's look at the total cost, which is saying, well, look, what's the total cost after 15 years if you're a low risk? So you're paying $18,000, 300 after 15 years if you don't make a down payment. And that's just going towards private mortgage insurance. So that's you giving the mortgage company money and saying, I'm not going to put 20% down, and this is how much I'm going to pay if I put nothing down on the house. So anytime I see these signs that say zero money down, I'm like, you don't realize that they're telling you they want $18,000 off you if you're a low credit risk. But at the same time, if you're a high credit risk, you know, if you put zero money down on it, except for your tax and license or tax and the notary fees, you're going to be giving them $73,000 in money. I don't know about you, but the last time I checked, that's a lot of dough and that's a lot of money to do something with. But the annual cost, if you were to invest this at 3.5% over 15 years, you would only bring in an extra $33,000 in interest on this at 3.5%. Now, if you went in the market and then made, 12%, clearly these numbers would tip the other direction. And yes, in some instances, it would make sense to not do this. But you have to also make the assumption that, hey, if I invested this in a vehicle, can I even touch this money if an emergency happened? So that's what leads to these decisions because it's not just one thing. You have to assume A, can I afford the monthly payment? And B, if I do this, you know, will I be able to have access to that money if something happens? And the other key factor is if I spend all that money and put a down payment on the house and make my payment super low, what happens in an emergency? If I deplete my entire emergency funds, it doesn't make sense. So again, it's tipping on either side of the coin depending on your scenario. So that's why we're not here to provide basically advice, but we're here to just point out the mathematical stuff to you. So what I did is I did some very simple logic to look at the annual cost to say, well, look, is this going to be cheaper? If I am a low credit risk, if I put no money down on the house and I invested instead. So with a low PMI of 0.5%, if you did not make a down payment, it would only cost you an annual premium of $1,200. You would make $2,200 in annual interest if you invested your down payment instead. In this case, it would make mathematical sense to not make a down payment since your PMI would be less than what you can earn in the market at 3.5%. Again, this is not advice, but mathematical opportunity cost logic. It's just simple logic here. And then the high PMI risk, if you're a high risk, if you did not make a down payment, this is saying, look, your annual premium would be $4,800 a year. And again, we're just keeping that same investment at 3.5%. You would make the same amount in interest if you invested in your down payment. But in this case, it would make sense to make a down payment since your PMI would be larger than what you can earn in the market at 3.5%. So again, you have to make that decision based on the mathematics of it to say, well, look, if I don't do this, what are the chances of me being in a really sticky situation and not being able to afford this? But also, your opportunity cost is just looking at this number. So I always do this. I look at this number, and this is math I didn't work out when I bought my house. So that's why I'm making this video to possibly help somebody try and make an informed decision. Where, look, if I invested this, if my broker came up to me and said, look, I can make you 8% on your money, Steven, I probably would have tipped this a different direction, but emotionally, I probably would have still made a down payment because I wanted to keep that payment as low as possible. Because trust me, I don't want to pay an extra 12 or $18,000 to a mortgage company. I mean, that's just free money that I'm giving them at that point. I'd much rather pad my payment and make sure that I can pay more towards principal and pay the house off early. That's what most people want to do. Now, if you make mortgage payments for 30 years, it doesn't make you a sucker. It doesn't make you, a bad person. It just says, look, you want to try and pay your house off as early as possible because otherwise you're going to be paying quite a bit in interest to the mortgage company. So I hope this video gave you a little bit more insight into seeing, well, look, if I invested my down payment instead of making it, what's the difference if I have a low PMI score or a high PMI score? What is that going to cost me? And does it make sense to make a down payment or not? Or invest that down payment and not make it and pay PMI insurance? So I hope this has been helpful for everybody. Thank you so much for taking the time to watch it. I am going to include a link to this estimator that I just created. I'm releasing it today. You're looking at a demo version of it, but I'm going to be releasing it on my website today. Please feel free, play around with the numbers, play around with the interest rate to see what you would get, and especially the mortgage duration, and just play around with it and see what it comes out to. And if you have any questions, let me know. But otherwise, I would really appreciate your support. Please hit the like button, subscribe to my channel. I'm going to do my best to put more videos just kind of discussing some of these mathematical phenomenons that most of us run into when we buy a house. But I hope this has been helpful for everybody. Y'all have a great rest of your day.